Hi, welcome to the latest episode of Manager Mix focused on alternatives. I'm your host Laura Dew, editor of Money Management, and with me today is Claire Smith, head of private asset sales at Schroders. Hi Claire, welcome to the show.
Hi Laura, thanks for having me on.
No, you're very welcome. So sort of to get us started, what do you think are some of the biggest misconceptions that investors have about private equity?
Yeah, I think when people think of private equity, they think of venture capital and they think of, Mark Zuckerberg in his dorm setting up Facebook. But actually, private equity is a huge universe. So it does start from that venture capital, that sort of an idea and a founder, right through to what we call growth, which is where you have a company that has a proven business model, but it might not be profitable yet, right through to what the term is buyout. So these are more profitable companies, sort of coined from the management buyout term. We further segment the buyout universe into small, mid and large because we think there's important differences between those parts of the market. And then finally, you can also have turnaround. So taking a company that is perhaps underperforming or underloved and returning that to a more profitable company. So yeah, I think when you think of private equity, there's actually this huge universe of companies you can access that happen to be unlisted.
Okay, and how does Schroders go about investing in private equity specifically?
So we focus on a few things. In venture capital, we like early stage venture, so that's sort of founder led. When you look at Asia, we like growth companies. We see some interesting demographic and wealth trends in Asia with increasing wealth of the middle class, changing consumption patterns. And then when we look at the more mature markets of North America and Europe, we like small to mid cap buyouts. So I think some people conflate small with new. These small buyouts are often not new companies. They might have been around for a few generations, but they might be previously family owned or founder led. So perhaps they didn't have the capital to sort of grow and expand. So it's a part of the private equity universe that we quite like. And we have an Australian unit trust that really focuses on this small to mid cap European and North American angle. And that's where you can often be the first port of institutional capital. You can help grow that company, professionalise it and effectively make it ready for that move up from sort of small to mid to large buyout, still often privately owned.
So what do private markets offer investors that they can't get from public markets?
So I think the biggest thing you can access in private markets is diversification. So when you look at listed markets, they're often becoming more and more concentrated. Think of the Mag 7. And we think tech is a really important trend in the coming years. But when you look at private markets, you can access companies that are more efficiently priced, give you a broader range. Another big trend we like in general markets is healthcare, say. But you look at the listed markets and there's only around 2,700 listed healthcare companies that you can access through the major markets. When you look at the private equity universe, we estimate that to be 145,000 privately held healthcare companies. So I think that's really important, especially when a lot of markets are looking more expensive. How are you going to find companies that have really good outlooks but are more attractively priced and that opportunity to grow?
Okay, and so what benefits does it bring to the companies?
Yeah, so being listed can have a lot of operational and regulatory restraints for the company. You think about quarterly earnings cycle, you think about daily share price movements, you think about, an ASX announcement every time something happens within the company. With private ownership, the board of directors and the company can get together and set a multi-year strategic plan. And everyone is very aligned in terms of executing that plan, and you lose a lot of these distractions that come with being listed. So what we really like is that really strong alignment of interest. So you have a new equity owner, you have that board of directors, that management team, and everyone is highly aligned on the business plan for the next 5 years. And then that usually will go into another round of ownership. So we like the fact that there is that better planning, better execution without some of the distractions that can come with being listed.
Okay, and markets have been volatile at the moment and they continue to be so. How does private equity typically fare during these volatile periods?
Yeah, so we just completed some analysis that I think is really interesting because, as you said, I think a lot of people are worried about the volatility in markets. They don't want to miss out on the upside, but also they're worried about potential corrections. We ran some analysis over about the last 20 years from dot-com bust to GFC to Eurozone crisis, COVID, return of inflation as we're calling it at the moment. And what we found is the long-term outperformance of private equity above listed markets is 4% per annum, which makes sense. So generally private equity is providing that outperformance. But interesting, when you look at these incidences of high volatility, the outperformance of private equity is even greater than the long-term average. So you're looking at about 8% outperformance of private equity versus listed markets when you have that more volatile environment. So I think that can provide a lot of comfort to investors who still want to have equity exposure and retain that exposure to the upside, but are a bit worried about, volatility or a correction in markets, because that's when private equity really does sort of prove its nettle and or metal and provide that greater outperformance versus listed markets.
Okay, and IPO exits for private equity fund managers have been down this year. Has that affected Schroders Capital's exits?
No, not so much, because we focus on that small to mid-cap private equity segment. We would normally, through a period, only exit about 10% of our companies through IPO, mostly because they are still generally small to mid-cap. We either sell to a bigger private equity firm or we sell to a corporate in that sort of same sector. So we've seen pretty consistent exits throughout the environment. We actually have had 2 of our most profitable exits between this year and last year. One of them we sold to a big sovereign wealth fund, so again, not relying on IPO markets, and another we sold to a bigger private equity fund. So being more focused on that small to mid-cap part of the market as opposed to the large cap, where you've really only either got to IPO or sell to another big fund, your buyer universe is much more limited.
Yeah.
We find that small to mid-cap part of the market does provide many more exit options and allows you to exit those companies without needing the IPO market to be open.
Okay, well, that's great to hear that you've had such good outcomes recently. Thanks so much for your insights, Claire.
Thanks, Laura. Thanks for having me on.
I've been your host, Laura Dew, and you've been watching The Manager Mix. See you next time.